Hey guys, Joel Franklin, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets, and I'm going to be talking about some of the key themes that we've got coming up this week that could be affecting things. And let me tell you, it is a blockbuster week when it comes to macro risk events. I think we should start really by just looking at the calendar. The big event of the week is the Fed meeting on Wednesday. Okay, we're expecting a downshift, another downshift in the pace of rate hikes to 25 basis points. Interest rates going to be lifted from the 0.25 to 0.5% range to 0.5 to 0.75%. And then markets are only actually pricing in one more rate hike after this in March. And that will be the final, according to the current market view, that would be the final rate hike of this cycle. And then we're expecting, or the markets at least are expecting rate cuts to begin later this year as inflation continues to dump lower towards the Fed's target. And as the US economy heads towards a recession, which pretty much everybody's expecting at this point. So yeah, that 25 basis points rate hike very much priced in at this point. The key thing here is going to be the tone from the Fed on the outlook for further rate hikes. Because like I just said, markets are only expecting one more rate hike. But what if the Fed signals that they still want to take interest rates above 5%? What if Powell, and in the statement, what if they're signaling 2 or 3 more 25 basis point rate hikes? Risks are potentially tilted in that direction. And that could cause a big jump in yields, particularly at the short end, like 2-year yields. That could trigger a jolt lower a jolt higher in the dollar, jolt lower in risk assets like stocks and crypto, probably a jolt lower in gold. So this is the big event of the week that we need to be watching. But there's a smattering of other very important US data as well, like ISM manufacturing PMI on Wednesday, JOLTS job openings, which is like your gauge for the demand for US labor. Then if you go to Friday, you got the official jobs report for January, and then ISM services PMI. So a lot to be thinking about in the US this week, and a lot to be thinking about outside of the US as well, because look at this. On Thursday, you got the Bank of England. They're expected to do another 50 basis point rate hike, and the ECB also expected to do another 50 basis point rate hike. And this divergence between the Bank of England and the ECB, which is still hawkish, still going 50 basis points against the Fed, which is slowing with their rate hikes, continues to sort of weigh on the dollar. Got the Dixie here, it's languishing close to recent lows. You can see, let me just show you euro, dollar and sterling. Yeah, both hanging out close to recent highs. Potentially here in sterling, potentially the formation of a bit of an ascending triangle actually, with buying pressure. And if we do get a spurt above this 125.50 resistance area, we could quite quickly hit this next resistance at just above 126.50. But anyway, back to the Dixie, because that's the main one I like to follow. And, it's pretty obvious that we're still in this same old downtrend that we've been talking about for quite some time. When you draw it up, it's not the nicest looking technical downtrend, but I expect that we will probably continue to head lower unless we get that big hawkish surprise from the Fed, which I sort of outlined just a second ago. In terms of other key events this week, gosh, is there anything I've forgotten? Yes, there is. Eurozone CPI. Okay, so, CPI in the Eurozone has remained higher than expected for longer than expected, which is why, and it's the same in the UK, actually. And that's why these two central banks, the ECB and the Bank of England, are sticking with a more hawkish line than the Fed, where there's been downside inflation surprises. So that'll be interesting on Wednesday. We're already getting a bit of a smattering of some of the national ones, like we had the Spanish one out this morning, which I think surprised to the upside. US consumer confidence data, that's always worth watching. Should be rising as inflation comes under control. And then New Zealand jobs data, quarterly jobs data, an important one for the loony traders, but not really, doesn't really have any bearing over the macro picture. So anyway, yeah, we've looked at the Dixie. What about stocks? Let's have a quick look at the S&P 500, or, this is CFD that tracks the S&P 500. Another key thing we got coming up this week is a lot of big earnings. Like we got Meta Platforms, formerly Facebook, on Wednesday. Then it's the three A's: Amazon, Alphabet, and Apple. Yes, that's right. They're all reporting on Thursday. So these are all behemoths that make up a huge proportion of the S&P 500's total market cap. So that's going to be very, very important alongside the Fed and alongside all of the data. And let's just talk for a second about the S&P 500 from a technical standpoint, because from a technical standpoint, okay, forget all the fundamentals, the risks of a hawkish Fed, the risks of the US going into recession and all this kind of stuff, which you could argue is bearish. The technicals are looking pretty good. We've ground above this long-term downtrend, which had been ruling since early 2022. We had a fallback and a retest of the 200-day moving average, and that got bought aggressively last week. So, technically speaking, it's looking like a possible test of the December highs is there, and a longer-term grind, perhaps over the course of the next couple of months, towards the August highs. Technically speaking, that all looks very, very possible. We just got to see how these fundamentals pan out, basically, if the Fed's not too hawkish. Because basically, I think the data this week is not going to shake up the market too much. Like the ISM data should just show that the US economy is weak and potentially recessionary already. The jobs data should just show a continued slowdown in the pace of hiring. In fact, let's just have a look at what we're expecting. Yeah, slight slowdown in the pace of hiring, slight rise in the unemployment rate, average hourly earnings growth to remain about constant. So the data shouldn't be where the shock is. And if the Fed doesn't signal that does signal that there's only one more rate hike after this, and then, it's kind of dovish, and if the earnings are good, or at least if the earnings aren't as bad as feared, we could get this continued grind higher. That's what the technicals are suggesting. It's kind of a similar story, by the way, for the NASDAQ. Let's just load the NASDAQ. Downtrend, kind of similar downtrend that was in play for all of 2022. We've broken above that, and now we're above this 200-day moving average for the first time. We're not as convincingly above it, but we're holding above it for now as we hold above 12K. But look, this was a key area of resistance in February and then in March and April last year. The door is slowly being opened, technically, to a run higher. These bearish long-term technical trends, they're being broken out of, and maybe we're going more positive, sort of neutral in the near term. I mean, I think it's still too early to call for the big bull market back to the record highs. Potentially, I think that could take a couple of years, or at least till the end of next year. But all worth thinking about. Right, let's round this up quickly because I'm going on too long now. Gold continues to hold nicely, comfortably above 1900. As the dollar continues to trend lower, which I think it probably will, as long as there's not a hawkish Fed shock, then I think you're going to continue to see gold doing pretty well. Oil, let's quick look at oil. You can see here that despite the grinding higher, the grinding lower of the dollar, the grinding higher of stocks, oil just cannot seem to break and hold or break above the low 82s, WTI that is, back in the upper 70s now. This resistance area that I was talking about actually for a couple of weeks, it's been holding pretty well. You've got China reopening, which has been supporting things, and the sort of the improvement in risk appetite, which is supporting things. But the big picture for oil is not so much about financial conditions, which are boosting stocks, but it's more just about straight up demand. And if we're talking about the US going into recession later this year, that's one of the biggest actually place for demand. So that's why we're struggling to get higher pretty much. Although, technically speaking, that's not quite right. There we go. Could be forming a bit of a ascending triangle in the long term. Like imagine if we pull back to here and then we get a bit of a rally back to the 80s again. I mean, that would very much be an ascending triangle pattern, which we know what happens with ascending triangles when they break. They can go boom pretty quick. So we could be back above 90 and testing these highs from when was that? November and October last year pretty quickly, which is where the 200-day moving average roughly is as well. And yeah, actually, whilst we're talking about oil, just keep an eye on these reports of Israeli attacks in Iran, because if things hit the fan with Iran, you know, and there is a blockade. I mean, I'm not saying it's going to happen, but like Iran has the power to blockade the Strait of Hormuz, which can pretty much cut off, like, I can't remember what the percentage is off the top of my head, but it's some staggering percentage of global oil supply, because you block off all the oil coming out of Kuwait and Iraq and Saudi Arabia and Bahrain from going through the Strait of Hormuz, which Iran has the power to do at the drop of a hat. Like if there's a war happening with Israel, and you know Israel as a proxy for the US, then that kind of response is possible. So just something to bear in mind. Markets don't seem to be paying too much attention to that, but it's a tail risk, let's call it that. But yeah, guys, hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.